So Dave, let's start with inflation. At the beginning of 2022, you listed inflation as your first risk for the markets. We're now 3 months into the year and inflation has continued to accelerate. What are your current thoughts on inflation and the trajectory of inflation, and when can we expect to see some relief on these high prices?
Yeah, so Joe, last week the Bureau of Labor Statistics reported that year-over-year inflation, as measured by the Consumer Price Index, was the highest in 41 years. It reported 8.5% year-over-year inflation. Now, our Federal Reserve aspires to maintain inflation at an average rate of 2%. Yet the market sees inflation averaging well over 3.5% for the next 5 years and averaging 2.5% over the next 30 years. So the graph on the right of this slide shows the dramatic increase in the market's 5-year inflation expectations. At the onset of the pandemic, investors thought inflation would be less than 0.25% for the ensuing 5 years. And now expectations are for greater than 3% inflation. This next chart shows the extent to which inflation has increased for necessities such as shelter, food, and medical care. We all frequently buy groceries, and we've certainly been experiencing sticker shock for meat, poultry, beef. Food inflation of nearly 9% is a very difficult pill for most of us to swallow. And the UN reported just the other day that higher food prices could be with us for a while due to the war in Ukraine. Now, I also think that higher rates of inflation for shelter are probably going to be with us for longer than many people might hope. Home prices are up, mortgage rates are up, the cost to heat and cool our homes are up, and all of this is compounded by a continuing housing shortage. Shelter inflation is just not likely to dissipate anytime soon. Now, the chart on the right displays the University of Michigan consumer expectations for inflation, which for the next year is about 5%, though I did see a survey just yesterday from the New York Federal Reserve that surveyed consumers who thought it would be closer to 6%. I have to say, Joe, it's been really interesting to read the vast number of mea culpas coming from those that just a year ago were in the transitory camp. I think we all could have predicted the inflation we are currently experiencing. I think the quote on this next chart sufficiently summarizes why we are seeing multi-generational highs in inflation. 3 economists from the Federal Reserve Bank of San Francisco stated, and I quote, "The sizable fiscal support measures aimed at counteracting the economic collapse due to COVID-19 could explain about 3 percentage points of the recent rise in inflation." Helicopters dropped a lot of money to a lot of people. And I certainly don't mean to imply that the fiscal support was unjustified. It's just the massive disruption to lives resulting from the pandemic required bold action. And we can't escape the fact that this bold action significantly altered the supply-demand balance that resulted in inflation. This next chart shows the extent to which we observed changes in consumer spending. In 2019, U.S. consumers collectively spent nearly $15 trillion. They spent 64% on services such as medical care, entertainment, travel, insurance. And spending in February of this year increased to an annual rate of nearly $17 trillion. But we're spending a larger percentage on goods rather than services. While 2.5% may not seem like that big of a shift, when applied to 17 trillion, it's huge. The left chart in this next slide shows the path of consumer spending adjusted for inflation over the past 10 years. While we certainly saw a big decline during the pandemic, current spending is back on trend with spending levels prior to the pandemic. But look at the right chart. spending on services remains meaningfully below trend. And as you can see on the next slide, spending on durable goods such as cars, appliances, and non-durable goods such as food and clothing, they're way above trend. It takes time for the economy to adapt to changes in consumer preferences. And when combined with supply chain disruptions caused by the pandemic, one can understand that inflation was going to be inevitable. But the question you asked, Joe, was when will this all end? I do think that energy prices are nearing a peak, absent any further major geopolitical events. But I'm afraid that we have a while to go before we see a correction to the current supply-demand imbalance for durable and non-durable goods. We have some significant hurdles to overcome, including labor shortages and supply chain disruptions. And as mentioned earlier, I do think that higher housing costs will be with us for some time, and a prolonged war in Ukraine would likely contribute to increased food inflation. I clearly don't believe that inflation rates will continue at levels above 8% for much more than maybe a couple of months. But I think we have a long journey ahead of us before we again see pre-pandemic rates of inflation.
That's great. And Dave, as we know, the Federal Reserve, they have a dual mandate of promoting full employment and also fighting inflation. So with the unemployment rate rapidly approaching pre-pandemic lows, the Federal Reserve has signaled, and the market believes, that the Fed will significantly be raising interest rates in the remainder of 22 and into 2023. Further, given the inverted and flat yield curves that I mentioned earlier in the webinar, the market seems to be signaling that a recession is imminent. Should we be worrying about a recession anytime soon?
Yeah, that's a difficult question, Joe. And before I answer, I want to take a look at current projections for U.S. economic growth. So on this next slide, the chart on the left shows the Atlanta Federal Reserve's current forecast for first quarter GDP growth, which is at 1.1%. That compares to the consensus of forecasts by economists of 1.9%. And these are not numbers that's going to excite anybody. But remember, Joe, it was just 3 months ago in January that we were dealing with the largest spike of COVID infections resulting from the Omicron variant. Hence, the anemic first quarter growth shouldn't really be a surprise to anyone. But now look at the right chart. Every 3 months, the Wall Street Journal surveys dozens of economists for their economic projections. And the consensus now clearly sees slower growth rates for the full year, which they attribute to higher interest rates from stubbornly high rates of inflation that we just talked about. In the most recent survey that was released on April 10th, economists surveyed placed the probability of a recession over the next year at 28%, and that's up from 18% just 3 months ago. So now what do I think? Let's face it, Joe, recessions are a fact of life. We will always have recessions. We had a really bad recession, dubbed the Great Recession, 14 years ago. And then we had the longest period in U.S. history of no recession until the onset of the pandemic. So if I had to predict, I would fall on the side of no recession in the next 12 months. This next slide supports why I believe there won't be a recession over the next year. We currently have a really strong labor market. Unemployment rates are near generational lows, and unemployment claims are essentially at all-time lows. We still have 10 million jobs that employers haven't filled. There remains ample economic activity resulting from what I've called the Great Transformation, which has contributed to higher than normal demand for homes, autos, and other durable goods. All that said, there will come a day when conditions normalize, economic growth pauses, human resilience adapts, and then economic growth will resume. I'll conclude by saying that predicting the beginning and the end of recessions is extremely difficult. No one can consistently predict them. Hence, we at Wespath prudently adhere to a long-term strategy based on our investment beliefs, and we avoid timing the market based on economic forecasts.
So Dave, I want to shift gears to another item that you had identified as a risk to the markets for 2022, and that's geopolitical risk. Specifically, I want to ask you about the impact of the Russian invasion and war on Ukraine. Recently, two prominent investors, Larry Fink, CEO of the largest asset manager BlackRock, and Howard Marks, who leads Wespath asset manager Oaktree, and someone I know who you follow closely, they both made comments about globalization. Notably, several media outlets reported that they were warning investors about the end of globalization as an outcome of the Russian invasion and also the swift response by countries and companies to economically isolate Russia. If true, would this not run counter to a core Wespath investment belief regarding moderate and sustainable growth led by the developing world?
Yes, Joe, unfortunately, we need to discuss the likely impact of this brutal and tragic Russian invasion of Ukraine, as it definitely is a factor weighing in the minds of investors. We certainly grieve for those suffering in Ukraine and from the senseless Russian aggression. We can only hope for a miracle to bring the senseless war to an end so that the Ukrainian people can rebuild and carry on with their lives. Now, first, I don't believe we've seen the end of globalization. Second, I don't agree that the Russian invasion is solely or even primarily responsible for countries taking a step back and examining the extent to which they are willing to rely on sourcing commodities and finished products from other countries. As we discussed earlier, the shift in demand and supply chain pressures resulting from lockdowns and other disruptions have adversely affected economic growth around the world. The disruption to energy supplies and trade with Russia, Ukraine, and others has certainly exacerbated the problems of fulfilling consumer demand and further fueling inflation. So let's, for a second, Joe, just assume that globalization is at risk. If so, one might ask, what economies have more work to do to adapt to this disruption? This next chart displays the extent to which various markets derive revenue from internal sources domestically rather than from exports. As you can see, European companies source 45% of their revenue from other buyers in Europe. Accordingly, 55% of their revenue comes from outside of Europe. In contrast, emerging country companies source 2/3 of their revenue from domestic sources. Hence, the end of globalization, if that were to occur, is a greater threat to the developed world than it is to the developing world. That said, the U.S. and other parts of the developed world are undoubtedly working on plans to reduce their reliance on what they may temporarily consider to be unreliable supply chains. But as we discussed earlier, Joe, the U.S. is currently facing a significant worker shortage. If we're going to reduce our reliance on supplies sourced outside of the United States, the only viable solution is to accept a meaningful increase in immigrants. And I'm not sure that our country is ready for significantly higher levels of immigration. But even if we were, we simply don't have the housing stock to provide shelter for more people. So the short answer, Joe, is that it's a much more complicated issue than some might have us believe. And as you know, Wespath has this optimistic worldview about world economic growth. And yes, the pandemic and now geopolitical conflict has temporarily interfered with our view of the evolution of the world economic playbook. But we remain optimistic about humankind's resilience in its ability to overcome whatever obstacles it encounters. We will undoubtedly see near-term changes, but long-term, I truly believe that the global marketplace will continue to expand.
So finally, Dave, I want to pivot once again to China, which we discussed during our last webinar. You told us 3 months ago that Wespath remained committed to maintaining exposure to China. But once again, the Chinese markets have disappointed with declines of roughly 15% for the first quarter. We continue to hear about human rights issues, COVID lockdowns, tighter regulations, and provocative signals regarding its intention to absorb Taiwan. When do you think we can expect to see improved investment performance from Wespath's holdings of Chinese securities, and what's it going to take to right this ship?
So you're right, Joe. The recent performance of Chinese stocks has been disappointing, especially when you compare it to the U.S. stock market. We've seen excellent returns from U.S. stocks over the past 2 years. Through last Wednesday, April 13th, the S&P 500 was up a cumulative 43% since the end of 2019, yet the Chinese market has lost 16% during that same period. After gaining 28% in 2020, Chinese stocks fell 22% last year, and as you mentioned, are down roughly 15% this year. The fact is, Joe, Chinese stocks are not for the faint of heart. The chart on the left displays the performance of Chinese stocks over the last 20 years, and they clearly have been in a wild ride. If you were to ignore all the fluctuations, the average compounded rate of return for the Chinese market has been about 10.5%. Yet, peak to trough, we saw a 73% drop during the great financial crisis in 2008-2009, and this current decline we are experiencing is about 55%. We can take some comfort in knowing that the Chinese market appears pretty cheap based upon forward earnings projections, with the current projected price-earnings ratio near historical lows. As a comparison, the forward price-earnings ratio for U.S. stocks is more than twice that of the Chinese market. So why has the market taken such a dive? There are many factors that have raised concerns among investors. The first is China's management of COVID. We all know that China has a zero COVID policy and will lock down cities at any sign of an infection. Shanghai, a city with a staggering population of 25 million people, is currently in lockdown while we're filming this webinar. And I've heard you say, Joe, that you've seen videos of what's transpired during this lockdown that you wish you wouldn't have seen. Lockdowns in Shanghai and elsewhere have certainly interfered with economic growth, and there's a lot of uncertainty among the investment community as to how long these lockdowns will continue to occur. Let's take a look at this next chart that shows the history of COVID infections in China compared to the United States. As we know, the coronavirus originated in China at the beginning of 2020. Chinese authorities immediately implemented strict control measures which successfully arrested spread of the virus. So I want to encourage our viewers to look closely at these two charts and specifically at the scale of the y-axis. Even though you see a big spike of Chinese infections on the left chart recently, the number of cases is trivial compared to what we experienced in the US for any of our 3 waves. Despite the current spike in Chinese cases, the total number of reported cases in China for the entirety of the pandemic is about 1/3 of the cases reported for just 1 day in the United States back in January. I saw a headline at the gym the other day that President Xi remains committed to strict COVID protocols. But I have to believe at some point the Chinese citizens are going to say they've had enough, especially if they're seeing videos like the ones you talked about, Joe. But for the time being, strict lockdowns will adversely affect the Chinese economy. Besides COVID, there are other factors such as stress in the property sector and increased regulations that are also having an impact. All that said, we and our asset managers continue to view China through a long-term lens. We simply cannot ignore China. It's the largest country in terms of population. It's the world's second largest economy and will likely surpass the US in a generation. We believe that rapid urbanization, China's commitment to its Belt Road Initiative, and increased wealth creation among the Chinese population will ultimately reward patient investors. We and our asset managers remain committed to our investments in China.
Great. Thanks, Dave. This is a great discussion in a complex and changing investment landscape.